Brett Villaume. I'm a board member of the Market Technicians Association, and I'm pleased to be interviewing Gary Antonacci, who is the author of Dual Momentum Investing and is a guest lecturer here at our Symposium in 2016. Welcome, Gary.
Thank you, Brett.
Gary, will you take a minute and introduce yourself for us?
Yes, I started in the investment business in 1974, looking for underexploited investment opportunities. I received my MBA degree from Harvard Business School, managed money part-time, and never had to get a job after that. In the 1980s, I managed some hedge funds, working with the top traders in the world, people like Paul Tudor Jones, Richard Dennis, John Henry, and didn't know if I would ever find anything as good as that again. But 7 years ago, I started researching momentum and found there's tremendous opportunity there, but it's not being exploited as well as it could be in the marketplace.
I see. And so the idea behind momentum is one that a lot of people understand, but the concept of dual momentum isn't one that is very popular. Explain dual momentum.
There are two types of momentum. The first, which most people are familiar with, is relative strength momentum,
right,
or sometimes called cross-sectional. That's the one that's dealt with predominantly in the academic papers, where you're comparing the strength of an asset to its peers. Absolute momentum, you're looking at strength on its own. You're comparing an asset to itself over time. Mm-hmm. It's a trend-following type approach.
Okay.
And by integrating the two together, you get the best of both worlds.
And that leads into I'd like to hear an explanation of what global equities momentum is, or GEM, which is the foundation of your book.
That's the model that I present in my book, and what it does is first determine whether the trend in stocks is up or down by using absolute momentum. If stocks are trending up, then it selects between US equities and the rest of the world.
Okay.
That's relative momentum. If the trend in stocks is down, then it opts for the safety of aggregate bonds until the trend in stocks turns positive.
And the performance historically is, the outperformance, I should say, is very strong.
About 700 basis points over the stock indices per year.
And as is noted in your book, I noticed that the risk of the GEM approach is much lower over different time frames as well.
That's correct. The maximum drawdown on a month-end basis is around 20% for dual momentum type portfolio versus over 50% for the stock indices.
Okay, very good. And why is it, do you think, more people don't use momentum, specifically an idea like GEM?
That's a great question. There's a number of reasons. First of all, are some of the same reasons why people don't use momentum, period, is that there's some behavioral factors taking place. There's conservatism, anchoring, people are reluctant to adopt something new. There's also the fact that momentum is a simple approach. Dual momentum, when you look at how it's constructed, looks very simple, and some people dismiss it. But I believe simpler is better.
In your book, you went into a lot of detail in the introductory chapters about why momentum is important and potentially all the reasons that you mentioned, behavioral reasons why it isn't. You didn't need to put those in there, but you did. What motivated you to do that?
I knew people would have some trouble accepting something that was so different from what they're used to. There are also biases that people have. For instance, there are a lot of value investors out there who resonate to the idea of buying something that's cheap. And when they see momentum, in which it looks like you're buying things after they've gone up, they wonder, how could this be valid?
And immediately dismiss it.
Yes, exactly.
Okay. Well, thank you very much, Gary.
My pleasure.